Hi everyone, welcome to today's video. So irrespective of whichever investor we tend to follow, for example, if we are following Mr. Warren Buffett or Mr. Ray Dalio or Mr. Vijay Kedia or Mr. Raamdeo Aggarwal, they all have their investing strategies. Usually what happens to us is that we would get to know that, okay, Mr. Raamdeo Aggarwal has purchased this stock or Mr. Vijay Kedia has purchased this stock, and we will run after purchasing that stock. And in majority of the times, what we do not realize is that they are working as per a specific strategy in mind. Now, I don't know. I'm not a mind reader. I would not be able to tell you what exact strategy Mr. Vijay Kedia is using or what specific strategy Mr. Warren Buffett is using. But on this video, I'm going to help you understand three very important strategies that are frequently used by stock market investors. I will explain it in very simple, easy to understand manner. So even if you're a beginner in the stock market, you will understand it. And along the way, I will give you relevant examples and discuss the name of a few stocks. Now that does not mean that this is a buying and selling recommendation. I'm just using it as an example. If it fits your profile, you could consider researching more about it, taking more positions on it, and you can act accordingly, but take it as my research input only. So with that viewpoint in mind, let us kickstart the discussion on specific strategies. And the first strategy is called as buying low and selling high. This is a very, very important and frequently used strategy. I also use it quite aggressively all the times. And there are multiple methods through which you can buy low and sell high. So let me discuss two very important ones. So the first strategy comes from Mr. Peter Lynch. He is a legendary investor. He has made a lot of money running his own hedge fund, and he has written several very good stock market investing books. So if you have the time, do definitely go and check them out. But here is the essence of his strategy. And he says that if there is a very good stock and it is not trading at its all-time high, but it is making its highest ever profits, then you could consider buying that stock. So let me run you through a couple of examples to illustrate this point. So let's pick a very simple example of HDFC Bank. So number one criteria of this strategy is that, hey, it should be a very good stock. So is HDFC Bank a very good stock? Okay, so all of us can debate about it, that it is good stock, it is not good stock, but do comment in the comment box that which according to you is the best bank in India. Now please do not say SBI, but do comment about your favorite bank. Now think about it this way, that HDFC Bank is probably one of the most trusted brands when it comes to banking in India. Its customer relationships is very good. It has had a history of clean management. If you study its book, it would have one of the least possible NPAs. So you don't need to be a financial market whiz to understand that HDFC Bank is a really good asset. So the first criteria was that the asset should be good. Now, is HDFC Bank a good stock or a bad stock? All of us can debate, but according to me, it's a very good asset to hold. It is one of India's leading banks. So we can definitely consider it to be a good asset. The second and third points are that the price or the current market price should not be trading at its all-time high. This is the second key criteria. The third key criteria we will get from the profit and loss statement. So if I just run you down through the profit and loss statement, what you will find is that, hey, 39,827 or approximately 38,151, these are highest ever profits for HDFC Bank. And let us very quickly check at what price HDFC Bank is currently trading. So it is trading at roughly 1500 rupees. And what has been the highest ever stock price for HDFC Bank? It has been 1656 here. So 1700 minus 1500, 200 rupees divided by 1700. There is still a decent amount of profit to be made if you are buying and holding this stock as per Mr. Peter Lynch strategy. So I hope this is a fairly easy method for anyone to understand whether or not you should be investing your money in HDFC Bank, at what point you should be selling it, etc., etc. Super simple method. There is nothing fancy that you need to do. So with that said, let me show you second method of buying low and selling high. And this is called as moving averages strategy. And here, in order to apply this strategy, you need to go on this particular website. It is called as tradingviewindia.com, and you can easily go there. It's a free website. There is no money that you need to pay. Now, what you do is that you go on this indicator, you go to simple moving averages indicator. And here, what you will see is that this is written as 50, 100 and 200. So you need to change this. So go on the settings tab and go on inputs, and the inputs that we need are 20, 50, and let us also change the style. So we will make this as black. We will make this 100-day indicator as blue, and let us make this brown or maroon. Now you can clearly see that this is 250 and 20-day moving averages. Now moving averages are forward looking or leading indicators. Leading indicators means that it indicates what is going to happen in the stock in the future or near future. So in simple terms, it is trying to predict the momentum of the stock. And what are you trying to do? You are trying to do a short-term bet on this stock, and you are trying to identify a good price to buy this stock. Because if your entry is good on this stock, and even if you don't exactly know where to sell it, you will most likely sell it on profit. So let me very quickly talk about when you should be buying this stock as per this strategy. So you can clearly see all these three different colors, and let me draw it out so that it becomes easy what line is what. So this is 200-day moving average line. This blue line is 50-day, and this brown or maroon line is 20-day moving average. So as per this strategy, there are two criteria that need to get fulfilled. Criteria number one is that the 200-day moving average line, it should be above the 50-day moving average line, and that should be above the 20-day moving average line. So basically this black line should come first, then this blue line, and this brown or maroon line should come last. Second criteria that also needs to get met here is that the price or the closing day price, and we are looking at it on our daily candle, the closing day price should be below all these three lines. If you get that indicator, then it becomes a good opportunity to buy that stock. So for example, here you can clearly see that this is for Tata Consultancy Services, and here there is black line, there is blue line, there is maroon line, and finally you have the price closing which is happening here. And this entire range becomes a good aggregation point for something like TCS. And I have told you that I am buying TCS, and this was one of the strategies that I used to identify TCS, because as per the simple moving average crossover indicator, it was coming down at a decent price. So now going forward, when am I going to sell this stock? So basically when opposite happens, that is when I would be selling this stock. So whenever I decide to sell this stock, I'll write a community post around it, and you can check. And if it fits your criteria, you could probably make the same call. Now in the market, you can buy so many stocks just by using these two strategies. Now let us talk about the second key criteria or second key set of strategies that you should know to make money in the stock market. And these are called as macroeconomic trends. This is very, very difficult to understand. I teach a stock market course also, where I teach quite extensively on how you can apply macroeconomic analysis. I teach a lot of fundamentals around macroeconomy. So if you deem fit, and if you want to learn more about macroeconomics from me, and if you like my teaching style, do consider joining that. But on this segment, let me quickly explain why macroeconomics is so very important. So first and foremost, when it comes to big investors like Mr. Warren Buffett, Mr. Ray Dalio, etc., they have useful information. They have a set of researchers who work with them. They will get you market information fairly quickly. If Mr. Warren Buffett has investments in Coca-Cola, he can call up the CEO of Coca-Cola, and that person will take Mr. Warren Buffett's call. But you and I as retail investors would not have that level of information. But guess what? Mr. Warren Buffett also has almost similar information when it comes to inflation adjustment and how the interest rates are going to be jacked up or not. And you and I also have access to that same macroeconomic data. So macroeconomy is your friend, and it is one of the most sensible ways of investing in the stock market. Let me prove that point by talking about a very simple example when you should not invest in the bond market. Because many a times you would be doing your fixed deposits at a very bad rate. So how do you identify what is the right time to invest in the bond market versus what is the right time to invest in the equities market? So very, very simple analysis, and here it goes. So basically what happens in the asset flow cycle is that a lot of money moves around between stock market and bond market. When the bond market is likely to give more returns, a lot of investors will put their money in the bond market. And when the stock market improves, a lot of money flows from bond market to stock market. Now, knowing this timing becomes really important. So let me first give you an academic response to this FD and bond market rate, and then I will give you some practical response. So here is an academic response as to when you should be investing in the bond market. So basically there is an inverse relationship between interest rates and bond prices. For example, if the interest rates in the economy is very, very high, then the bond prices will be low. Then you should probably be buying bonds at that point in time, because if you can buy low, then you can sell the bonds at a higher price. So this is what teachers would tell you. But there is a small mistake here, and the mistake is that basically this is an expectation game. Expectation means that if people think that the interest rates are going to go up, then which means that the prices will come down, then you should be buying the bonds later, not now. But if you feel that the interest rates are going to come down in the future, then you should be buying the bonds as of now. Why is that? Because if the interest rates in the future goes low, that will mean that the bond prices will go high, and you can sell off the bonds that you're purchasing now. Problem in this entire game happens that you would not know when the interest rates are going to move, because you cannot push the hands of RBI or Feds, etc., etc., and it becomes a very difficult guessing game. Okay, so here comes a practical response to this entire thing when you should be investing or buying bonds, because buying bonds is equivalent to doing a fixed deposit. So let me help you understand that by picking a practical example. For example, if you would have gone to HDFC Bank 6 months ago, the FD rates that they were offering were close to 4.5%. Should you have picked your FD rates at that point in time? The answer was no. Why? Because if you fix a fixed deposit at 4.5%, and if you continue that, you will only make 4.5% return in 1 year. But right now, if you go and check the fixed deposit rate, and here are the 1 year fixed deposit rates as of today, they have gone up. They have become 5.5%. Now your natural question will come that, hey, is this 5.5% enough? Am I getting the bond at the right price? And should I consider bond investing at this point in time? So let me run you through some math. So let's say that you invest 100 rupees at 4.5%, then what is the total money that you are getting in form of interest? You are getting 4.5 rupees. But FD returns are taxed, and most likely you might fall in this 25% tax category. So what is the total tax that you will pay? You will pay roughly 1 rupee of tax. So what is the total return that you are making? You are making 3.5 rupees return. This is very, very important, because now what you need to do is that you need to execute step 2. Step 2 is that take a look at expected inflation in the economy. And here is a very important study that was done where, according to government, they are targeting inflation at roughly 4%. So your money in real terms in fixed deposit is going up by 3.5%. Inflation targeted is 4%. So you're losing money. Now, is it the right time to do bond investing? Let us run the same math. So for example, right now the fixed deposit rates are 5.5%. which means that you are going to make 5.5 rupees. So net, how much are you going to make after tax? You are still going to make more than 4 rupees. Now, please do not start a fight in the comment box saying that, you know what, that FD returns are not beating the market, this, that. FDs are not supposed to give you much real return. It will always stay very close to inflation. So the only decision point that you have as a normal investor is that are FD rates going to give you real returns as per the inflation expectation? If the answer is yes, then it is an okay time to invest in bonds. In case you are considering bond investing, you can check out Golden Pie. They are the sponsors of this video, and they are the #1 bond buying platforms in India. And using the link in the comment box, you can check some of the options that they have listed on their platform. And these are all sensible options. I have also created a separate guide as to how you can go and consider investing in bonds. But to cut the long story short, by understanding the macro dynamics, you can easily make the first decision whether you should be investing more of your money in the stock market or bond market, or taking a balanced position. So now let's say that you divert some of your money to the bond market and some of your money to the stock market. So how you can use macro analysis to make money in the stocks? Very simple. Take a look at the second indicator, which is called as the unemployment indicator. Now, what is meant by unemployment indicator? It simply tells us the level of unemployment that is currently existing in the economy. For this, always take a look at the US based data, because the data there is much cleaner, because India is a more informal economy. So here, capturing that unemployment data might or might not be correct, but US gives a very good indication what is happening at a global level. So if you check here, what you will notice is that the unemployment rate is falling, and it has fallen quite aggressively. It has not reached its absolute low the way it was pre-COVID levels, but it is getting crushed quite a lot. Now, what does this mean, and how does this relate to the stock market? Fairly simple. What is meant by very low levels of unemployment? In very simple words, it means that people have employment. They are employed. Now, if they are employed, they would want to avail more services, things, and businesses that are creating soap, shampoo, and bunch of other different things, they are likely to run at a decent capacity. So they have incentive to produce, which means that there is going to be a growth cycle that is going to be underway. So low levels of unemployment, especially when it has started to come down, is a great macro indicator that a bull run is about to start. Now, using this information, you can make very easy bets in the stock market right now, because think about it this way, that if the employment cycle continues at its full strength over the next 5-6 months, then what is going to happen? People are going to build disposable income. That their disposable income or the spare income that they have, they would be able to create some cushion, and they are going to buy what type of goods? They are most likely going to buy luxury oriented goods and consumer durable goods. And that is the reason why I had been aggregating consumer durable goods. For example, V-Guard, Havels, Whirlpool, these have been some of my top picks. Now, is this a recommendation from my side for you to buy? Absolutely not. Please do your own due diligence. But I am an investor in all these 3 stocks. Now, another key important matrix that you can use here is the credit growth cycle. Credit growth simply means that how much money is being pushed by banks into the economy. And how do you decide that? That how easy or tough it is to take loans. So one way of testing it is that go meet your relationship manager at a bank and ask whether or not they would give you banks. Run that experiment and figure out, are banks more conducive to giving loans right now or not? So that will give you a small sample set in terms of credit uptake in the economy. The second key way of doing this analysis is to look at how much home loans the banks have started to give now, and is that on the upswing or not? Because home loan is probably a slightly more pricey loans. So if the banks have started to give out a lot more home loans, then it is very much given that they are going to give automobile loans and bunch of other loans as well. And that study is very easy to figure out. And here is the data for you. And it says that the non-fruit credit growth continued upward trajectory and it jumped 15.1%. The credit growth for banks is driven by retail, especially home loans, which constitute 50% of retail loans. India's home loan market, currently valued at 24 trillion, is expected to increase by 100% in the next 5 years. And the final sentence is very important. While the loan growth improved significantly for the banking sector in Q1 financial year 23, private sector banks fared better compared to their public sector peers. So what they are simply saying is that, hey, home loan book is also growing and the entire credit uptake in the economy is growing. So from that particular perspective, I have been very, very bullish on the real estate resurgence. In case you don't want to invest in banks that are giving home loans, for example, AU Small Finance and a bunch of other banks whose loan book is made of giving home loans, you can invest in companies that will benefit with the upswing of the retail sector. A classic case in point would be something like Havels. They will all benefit if more houses are being constructed because people will need to put wires and people will need to paint their house. So automatically there will be an uprun on these stocks. So now comes my final strategy. This is called as momentum investing. It is called as buying high and selling higher. That is the goal with which we do momentum investing. I had made a separate video. All you guys liked it. So I thought that I will add one more example to it and I will show you that there is a great opportunity here, even from a momentum point of view, on one of my stock picks. And that stock pick is AU Small Finance Bank. So let me first and foremost show you AU Small Finance Bank because I do momentum investing in really good stocks only. And I feel that AU Small Finance Bank is a very good stock. So you can clearly see that there has been a massive revenue growth. So it fits Peter Lynch's strategy and also the profits are almost at their all-time high. And is it trading at its all-time high? The answer is no. The recent high was 717 rupees. Right now it is trading at roughly 650 rupees. So a fair enough margin. So now let me very quickly talk about it from a momentum investing context. Again, for entire context, please watch the entire video, but I'll present a very quick summary here. So basically in momentum investing, what you are trying to do is that you are trying to identify the 52-week high or a fairly long high that it has previously made. For example, right now the stock is trading somewhere here, and has it made this high earlier? And the answer is yes. This stock has made this high 1 year back also. Then it made another high H2 and it gave a little bit of a breakout. Then it went back and then it gave another breakout. It reached here. Then it danced around and now it is hitting that same point as H1 and H2. So H3 is somewhat equal to H2 and H1 in terms of pricing. So now whenever this stock gives a breakout from this point, it is going to become a rocket. Now you might have a counter question that Akshat, it did not give a much breakout here after it had reached its previous high. Okay, completely agree. But look at the time period when this fall happened. This was when the entire markets were falling after November, right? So it was trying to break this and it gave a small breakout, but then the entire market fell and it fell with it. So now it looks to me that this H3 point becomes a very, very viable point and I will be amping up my positions in AU Small Finance more. Now again, this is not a recommendation from my side to go and invest more of your money in AU Small Finance. On this video, I had presented multiple options. If you want to go and purchase stocks like TCS, use the strategy that I'm saying. If you want to do bond investing, use the strategy that I'm saying. If you want to invest in AU Small Finance like companies, again, I have explained you with strategy how you should be doing it. Depending on your risk appetite, my advice would be to become a balanced investor, invest a little bit of money in everything. That way you will be able to craft a very well balanced portfolio. That is always the goal. But I hope you got the entire understanding how you can utilize these three strategies to make money in the stock market. I wish you the best and I really hope that markets give out a breakout and all of us make a lot of money. Thank you so much for watching and I'll see you soon.